talking R&D tax credits with Tom McNally from Alvarez and Marsal, right?
That'll be good.
And this will be good because we have a lot of customers that do take advantage of the R&D tax credits. And we have a lot of customers that ask, what is this all about?
It's kind of a confusing space, right? Everybody knows they should. Nobody really knows how to get over the hump. There's all these providers out there. You really need to get down to the nuts and bolts because it does come back down to, are you eligible? And then are you accounting for it and doing it in the right way to be able to do all that? We'll get into the details.
We'll get into the details.
It's a great opportunity, and it's really a tried and true thing.
But before we go into that, before we bring Tom on, we're going to talk a little bit about this weekend and a new stimulus package. I guess it wasn't a package, right? It was a bunch of executive orders, but there's no name to it.
Well, that's because it's a bunch of executive orders from Trump.
But we should give it a name: Trump pump. Stimulus Trump pump.
The Trump pump for the economy. I think he would actually. He's going to tweet that.
He's going to tweet
because he listens to it. Well, no, if he listens to our podcast.
So who's got the power of the purse now?
Yeah. Madison might want to know that.
Madison's rolling in his grave right now. He's just like, wait a minute, who's got the power of the purse? Trump does.
No, it's kind of amazing. I mean, there's 4 executive orders.
Yep.
One about unemployment, 2 payroll tax, 3 evictions, and 4 student loans. And
student loans was the 4th, right?
Yeah, student loans. I think the first one, the enhanced unemployment, has the most teeth to it,
right?
Because the money has already been allocated, or part of the money's already been allocated. But
300 is coming from the Fed. I believe it's coming from FEMA. I'm not sure what the correlation there is. And my guess is with 30 million plus Americans, not new claims, but existing claims. Right. That money's probably going to run out rather quickly. I read a Wall Street Journal article this morning that it's going to be weeks, not the end of the year.
Within 6 weeks, right?
So without getting Congress back involved, I don't know. This is another Band-Aid, right? Let's face it.
I think it's, we're talking about an election year, right? I mean, we got to take that into account, right? So the details of that one is $400 retroactive to August 1st. So kind of going back to when the $600 ended per week. Kind of putting in place $400 a week, 300 which is coming from the feds, ultimately from FEMA somehow, and 100 of which is coming from the states. They're not required to do it, and the monies have already been allocated to the states. This is coming from previously allocated CARES Act.
Must be the CARES Act.
And states have already started to do stuff with that, so they probably be like, well, don't tell me to.
Right, the CARES. I mean, let's face it, the states are already going broke, right? Another article this morning was just like how the states and the pullback on spending is actually going to ultimately be a drag on the economy. So let's see where this ends up. Unfortunately,
but what's the next thing about Trump pump?
Trump pump is the payroll tax. That's the other big one because there is actually. There is some support, but not a whole lot of broad support for that. And of course, because he doesn't have the power of the purse, unless you ask him, it's actually a deferment of payroll taxes, which is really scary because it adds another level of uncertainty
and risk.
Right. If you think about just going back not 6 months yet, but 5 months with the PPP loan, the forgiveness, whether or not the forgiveness is taxable or if it's taxable. I mean, Congress's intent versus the IRS's intent.
Yeah.
Here we are again, more uncertainty. And let's face it, this is going to ultimately be a liability on the balance sheet. But to boot, because it's a two-sided payroll, two-sided tax.
You got your employees and your employer's portion of that.
And of course, the employees want more money in their pocket. So employees are probably going to be pushing for this. But who ultimately owns that liability? Yeah, there's a lot of talk if I become president again, I'm going to make this permanently forgivable.
Right.
Yeah. Okay. It just doesn't go away that way. So what's next?
Yeah. So employees are going to want that, right? More money in my pocket, but it's going to be on the employer's balance sheet to be paid, right? Both sides of it, the employees and the employer's portion of it, as always. But the employer is not, if they elected to do this in certain ways, they're not going to be withholding that from the employees. So the employees have more money, so they can spend more money, right? Boost the economy. But let's say that employee leaves in end of November,
and this is not forgivable.
You got September, October, and November's worth of
withholdings
that you don't have from the employee. They go off on their merry little way, and you're left with that piece of the pie on your books to be paid. And it's not
even on your books. That's the problem.
Well, it needs to be, right?
Keep it on the books. So this is going to kind of be an interesting moment. I have not heard customers asking about this yet, but I know it's going to happen. but let's kind of, I guess my recommendation is don't take advantage of the payroll tax deferment. There is not enough clarity. It's ultimately going to add more risk and uncertainty to already.
Yeah, I mean, I gotta go back to like some new customers that come on board. They come on board because they have not kept up with their books. They've not kept up with their payroll taxes. They come and they're like, I got a big payroll tax liability. This is basically signing up for a big payroll tax liability, right?
We usually don't talk this fast, but we do want to spend more time with Tom. But we definitely had to throw in the Trump pump into this because every stimulus package really needs a name. So, anyways, with all that said, let's bring Tom on.
Yeah, just the last two pieces of those, the executive orders. One was about evictions and one was about student loans. Neither of those have as much kind of meat on the bones or teeth to them, but it gave Mnuchin and others the ability to explore extending those pieces.
Cool. All right. And
but with that, let's jump into the R&D task area because that is much more tried and true, established, and a lot of people can take advantage of.
Yeah, and there are many ways to take advantage. I'm sure Tom's going to talk with. Hey, Tom.
Dan and Steven, how are you doing this afternoon?
Good. I don't know if you caught the last few seconds of that as you were coming into the room, but
Tom's like, what did I just get myself involved in?
No, I think it's great. I think with all of the coronavirus related stimulus and all of the developments this year, we're going to need an updated version of the Schoolhouse Rock, I'm Just a Bill on Capitol Hill cartoon to cover executive orders and IRS FAQs and all the other fun that we've been having over the last 5 months, 6 months, 6 years, however long it's been.
Yeah, no, we'll stick around for a while.
I do remember. Do you remember?
Yeah.
You do? All right.
I like the reference.
Yeah, we just burned bills in. All right. Anyways, enough of that.
So, Tom, you want to give us a quick intro to yourself and Alvarez and
Marsal?
Sure. So just a quick intro to Alvarez and Marsal. We were founded in the mid '80s by Tony Alvarez and Brian Marsal, two professionals in the corporate restructuring industry, and for the first 10 to 15 years or so of the firm's existence, we were primarily a restructuring boutique, helping companies with turnarounds and workouts. From about 2000 forward, we've really worked to become more of a full spectrum consulting firm, adding business consulting, valuations, private equity services, tax, and transaction advisory to the mix. We're still, of course, highly known for restructuring services. If you see us pop up in trade journal articles or the news, it's usually in conjunction with those types of projects. Kind of our biggest accomplishment was being the lead restructuring advisor on the Lehman Brothers bankruptcy back in 2008, 2009, which is still the largest bankruptcy in U.S. corporate history.
In terms of
yeah, it was a little disruptive for its time. Just kind of my personal background, grew up in Louisiana, lived in the Houston, Texas area for the last 20 years with my wife and 3 daughters. I was started my career at the old Arthur Andersen, was around Arthur Andersen for its last 2 years, then later transitioned from the audit practice to tax after law school. I co-founded TRCG Advisors, which was a boutique firm working primarily with small and middle market companies on the R&D tax credit, and co-founded that about 10 years ago, and then sold it to Alvarez and Marsal in 2017, and that's when I joined A&M. Our R&D practice is about 25 professionals, primarily attorneys, CPAs, and engineering and basic sciences professionals. So kind of a cross-functional, multidisciplinary team on the R&D credit. We work with companies ranging from Fortune 100 to pre-revenue startups, and we've worked both U.S.-wide, and we've got peers in a few other countries as well.
Cool. So the research and development tax credit, R&D tax credit. What's, your 30-second, like, what is it? And, what are some of the nuances about it? When did it start? Is there a termination date to this? Is it sort of just ongoing?
Sure, great question. So the R&D credit at the federal level has been around for almost 40 years now, and
Wow.
it's had a couple of big changes. It's a general business credit, and it's earned primarily, companies earn it primarily by investing in what the tax code defines as qualified research. I'm sure we'll get back to that term, qualified research, because there's a big difference between the tax code definition of R&D and then kind of the pop culture definition of R&D. Credits are primarily earned by spending on wages, materials, and outside services on R&D projects. There's a federal credit. There's also roughly about 40 states or so have state credits. And as I'm sure we'll discuss a little bit further, in the past few years, there's been a sea change in how smaller companies can utilize the credit. That's opened up avenues for these credits to be monetized much faster and much more efficiently by small companies in particular.
And just for the audience, like one of the key ways, not to like, but I know enough to be dangerous, right?
Yeah.
One of the key ways to loop back to Trump pump is that it relates to payroll tax, right? Just
Correct.
Give people the quick version of that.
Sure. So in 2015, this was under the Obama administration. This was the last major tax legislative package that was passed. It was known as the PATH Act. A new feature of the R&D credit was written into the law, and also just to go back to one thing Dan had asked about earlier, the PATH Act also made this R&D credit at the federal level permanent. It used to be a temporary provision of the tax code. Okay. PATH Act made the R&D credit permanent. It also created what's known as the qualified small business R&D credit. So if you have a company, we call this the rule of 5 years, 5 million. If you have a company with 5 or fewer years of gross receipts and less than $5 million in gross receipts for a tax year that you have under consideration, these companies, which are known as qualified small businesses, can take an R&D credit, which is normally an income tax offset, and use it to offset the employer share of Social Security taxes, are also known as OASDI tax. And what that's done is it's really opened the door for more early stage companies to get some value out of the R&D credit, because obviously a lot of early stage companies, they might be doing a lot of R&D, but they're not really generating taxable income. So normally a tax credit is of no value to someone who's not paying tax.
Right.
So what the federal government has done is allowed you to move the credits from income tax, where you're not really paying anything, over to payroll taxes, where as long as you have U.S. employees, you're going to be paying payroll taxes.
Got it. And that's where the boom in the last 5 years have come from from startups, emerging growth businesses, being able to actually finally take advantage. Now, one of the, to be a little dangerous, because we've gone through this process with many customers, in order to qualify sort of that filter, is that it doesn't have to be just a product. It could be an internal process, is my understanding, but it needs to be, I guess it's novel and innovative. Is that one of the filters, or before you jump into an R&D tax credit study?
Sure. So the tax code lays out a 4-part test for qualified research, and without belaboring all 4 of the tests, the big test that everyone focuses on is that a taxpayer has to have developed a new or improved business component for a permitted purpose. Business components are defined as products, processes, software applications, formulas, techniques, and inventions. So you've developed that component for the permitted purpose. Permitted purpose meaning you're trying to impart new quality, functionality, reliability, performance, durability. Mm-hmm. And that component just has to be new it just has to really be new or novel to the individual taxpayer or company, not necessarily new to the entire industry. There used to be more of a high threshold of innovation standard, which really did limit qualified research to the, kind of more of the big conceptual type of greenfield R&D.
So it doesn't have to be another
now
iPhone.
it's exactly. Exactly. It doesn't matter that there's already maybe a product in the market that has kind of similar performance characteristics. It's the fact that you're going through the trial and error to bring that to market. That's what is most important.
Right, and it's, to say it another way, like I can implement best practices from my industry and call them new and improved within my organization, and that some of that will qualify for the R&D tax credit.
Isn't it amazing that more small businesses don't actually take advantage of the R&D tax credit? Because let's face it, in the service-based business, 30 to 50% of your expenses, of your revenue, not even of your expenses, of your total revenue actually is generated from payroll, right? But I guess you do have to have that qualification, right?
So you got to spend the time and to put together, do that study.
So let's talk about that study. So what is that typical R&D tax credit study?
Yeah. So in R&D study simply is the professional service that we deploy to identify, quantify, document, and support an R&D credit claim, either at the federal level or at the state level, oftentimes done in conjunction. And the reason why clients engage us for a couple of reasons. There's a performance reason. We often find significantly more savings than clients thought that they could identify on the front end, just kind of looking at it big picture. And then also we perform all of the analysis that substantiates the credit, such that if the credit's ever audited by either the IRS or a state taxing authority, we've come through, we've asked and answered all the questions, we've prepared all the documentation, we've got all the quantitative schedules prepared to where it can withstand the audit scrutiny.
I'm curious, that 5-year threshold, $5 million, is that 5 years based on ownership change, or is it a function of the underlying entity, the formation? What is that 5-year test or threshold?
It's a little bit undefined, just because this is still in tax, in the world of tax, it's still a fairly new concept. But all of the guidance thus far indicates it's more tied to the entity. Now, you do have to perform some control group analysis to see if there's related companies or entities with under certain common ownership, which might affect whether or not a given entity would be a qualified small business. But kind of for big picture, it's more tied to the entity itself. So when you have change in control or a recapitalization or something like that, it's going to be a little bit more tied to more of the former.
Even for my own benefit and for the audience, that qualified small business, that entitles you to apply this to payroll tax. But
correct.
Businesses that are 30 years old are still eligible for the R&D tax credit. It's just going to only apply to income tax, meaning if I'm 30 years old, I need to be making a profit in order to actually get the value out of this. I can't apply it to those other things. Correct?
Correct. But yes, but even companies who might not be able to immediately monetize an R&D credit, there's still some good reasons to perform the analysis and potentially file a claim. One is these credits they can be carried back 1 year or carried forward for up to 20. They have potential value in transactions. Also, one issue or opportunity that's come up with CARES Act is obviously a lot of companies will be generating net operating losses in 2020. CARES Act provides for an extended carryback of those net operating losses. So we anticipate a lot of companies who will generate net operating losses in 2020 will primarily deploy those NOLs in prior tax years, meaning if they have a return to income in 2021 or 2022, they could really use some R&D credits to offset that tax hit. Whereas in a normal year, if you would have lost money in year one, you'd probably mostly be looking at just using those NOLs on a carry forward basis, unless you had a big year the year before.
I'm curious about the cadence. Like, is this something that, so in your world, do you find companies every year coming to take another bite at that apple, or is this usually a one-time, okay, you re-innovated, then that's it? Is it transactional, is it recurring?
Yeah, most companies re-engage us year over year because we're very non-invasive, and they also like that having the assurance that they're claiming the most amount of credits they can possibly claim, and we're preparing all of the supporting materials to be able to substantiate that claim, and they can securely take the position on the tax return.
Mm-hmm. Two questions, one quick, one a little longer. Is there a cap on how much value?
Oh, that's a good question.
So there is an annual cap on the qualified small business credit. So if a company meets that, is in that 5 years, $5 million threshold, they can only claim $250,000 a year in payroll tax offsets. However, just for the general R&D credit, there's no cap. But for quick math purposes, most taxpayers, their R&D credits work out to somewhere between 5 and 10% of their qualified spend, and that's at the federal level. States, the math works a little bit differently.
Second question, one of the big things that we've been talking to people about in this in 2020 is, and even in the last 2 weeks, is we've got to move from the survive to thrive mindset. We haven't all survived, but those of us that have survived in coronavirus, how do we move our mindset and our focus and our planning to thriving, right? And one of the big things is you got to invest in your business, you got to invest in infrastructure. And that is different for a lot of different organizations. It might be marketing, it might be new product, it might be people. Like you got to put that plan together for yourself. But trying to tie this back, like one, what does the CARES Act do in terms of the carry back? How many more years can I go carry back? And two, now I've got PPP money and I've got EIDL money. A lot of small businesses do, and they're figuring out how to invest this. Like tie this back into the R&D tax credit. If I invest some of this EIDL money in qualified R&D stuff, how many years back that I might have been profitable a few years ago, but I'm not going to be profitable this year. How can I take advantage of that today and not going forward? Sure.
So the CARES Act doesn't provide, for clarification, the CARES Act does not provide an extended carryback of the R&D credit itself, but the R&D credit, a taxpayer can go back into an open statute tax year. So usually you have 3 years from the date you filed a tax return to go back and amend it for any reason. So we do have companies that are more interested in retroactive claims of the R&D credit to potentially find refunds for related to R&D credits in prior tax years. It might have been the case they just didn't either were unaware of the credit or they were so busy in those years they skipped the analysis when they had filed the returns. Obviously now during an economic downturn, cash is king. And so they're looking at potential areas where they can recover overpayments in prior years. So the R&D credit is potentially a good source of recovery and refund for those periods.
Right. So can we play off of this with an example? So let's say we have a small, medium-sized business. The last 3 years, they've paid taxes on $1 million in net income. And so let's say 2017, 2018, 2019, $1 million, you pay taxes, and now you're here and you're going to break even this year.
And in those 3 years, you did not do the R&D tax credit.
And you did not do the R&D tax. But this year, I've got PPP money, EIDL money, and I'm looking at thriving. I'm going to invest into my business this year, even though I'm not making money, but I have this pool of capital. And let's say I invest $1 million worth of people time and labor this year. how does that, what is the quick and dirty calculation there? Just for example.
Sure. So let's say that you, to use an easy example, R&D spending a lot of times is driven by your spend on individuals working in engineering and scientific type roles. So let's say that you went and hired, if you're a software company, you went and hired 10 more developers with an annual wage of $100,000. That's your $1 million. The R&D credit related to that additional $1 million of R&D spend would probably be something like $50,000 to $100,000 in tax credits. And that's in addition to R&D credits you could earn on just your ongoing spend for individuals working in those roles or investments you've made just on an annual basis. One thing that can affect the R&D credit year over year is if you have a drop in headcount in those types of roles. But obviously with PPP, a lot of companies have, the whole point of PPP was to maintain payroll. And so companies have been maintaining those wages across the board, and therefore the R&D credit should still be steady for them.
Cool. So that let's just call it $50,000. I got $50,000 credit in my 2020 tax year when I go and file my 2020 taxes, and I can use that in 2020, or I could carry that back to 2019, or I can carry it forward for
Correct.
20 years. And then what you're saying about the CARES Act, allows us to retroactively change, amend tax returns. So additionally, I could go back, since I'm now investing the time in the R&D study. I'm already there. I could go back, I believe was what you're saying, Tom. I could go back 3 years and amend my taxes and look at what my qualified spend was in R&D for those that ongoing spend. Let's say for those 2 engineers I did have on staff before EIDL. And so I could amend those tax years and get potential, like maybe call it 5 grand in each of those tax years, 15 grand that I overpaid in taxes, and I get that money back.
Correct. And to clarify, you can go back into those open statute tax years, regardless of CARES Act. The other point that I do want to bring up is the qualified small business credit. So the payroll tax offset, that's only available on a prospective basis. So you cannot amend a tax return to pick up the qualified to pick up what we call the QSB credit, the qualified small business credit. But the regular R&D credit to offset income tax, yes, you can amend prior year returns to claim those credits.
This was good.
Yeah.
So Tom, if an audience member or one of our customers want to get in touch with you, obviously we know how to get in touch with you. What's the best way to get in touch with you, Tom?
Sure. Easiest way is you can send me an email at tnally, TNALLY at alvarezandmarsal.com. And we're soon going to be rolling out a blog on our website for the R&D credit, and I'll share that with you guys and send it around. We're about a couple times a week. We'll probably be posting some kind of quick insights on some of these fast developing issues, as CARES Act and what did you guys call it? The Trump pump.
The Trump.
Some of those types of
we're gonna get into trouble.
things come up. Yeah, this is there's lots of, there's been some years it's a little bit boring. There's not a whole lot of new stuff to put content out for, but this year it's once a week, it seems.
We could have a whole episode on this.
Quickly, because I know I'll get it from a customer. I've got PPP money. I'm giving forgiven on the PPP money. Is there any restriction to me including payroll that I'm getting forgiven in a study, an R&D study?
No. Right.
So
no. And I mean,
double dip there a little bit.
Effectively. I mean, if you think about it, just as forgiven PPP loans are not includable in income, they're not going to impact your R&D. You're not going to have to carve that out of your R&D calculation. Potentially now, of course, that could change. I mean, there's discussions right now of extending PPP, and I want to say in one of either the HEROES Act or the HEALS Act, which is the two competing bills coming out of the House and Senate, I want to say that one of those bills has forgiven PPP amount, extra PPP that they would dole out being includable. in income, but that's prospective and hasn't become law yet and what have you. But but for right now, yes, there's no impact.
Cool. Well, this was great, Tom. So that's Tom Nally from Alvarez and Marsal. Appreciate your time, man.
Yeah, thanks for joining us. And
Gentlemen, it's been a pleasure.
If we do get to travel, I was just talking to one of our employees the other day about Louisiana. What's the best place to go besides New Orleans?
Well, I'm a New Orleans guy, so I'm going to say New Orleans. But no, there's a lot of course, Cajun country is a lot of fun, which is down around Lafayette, Louisiana. There's a lot of great fishing on the Gulf Coast as well. And I'm also I'm an LSU guy, so I'm pretty partial to Baton Rouge as well. But there's no shortage of great places to eat. So you might want to
when we can
might want to fast for about a month before you go down.
Cool. Thanks, Tom. Appreciate it.
All right, gentlemen. Thank you.
Tom. Thank you. Well, that was good. That was fun. We talk a lot about R&D tax credits with customers. Sometimes I'm concerned as to how some of our customers do and how some small businesses do claim that R&D tax credit, because it is something that it's just not like on a piece of paper you throw in, oh, I spent $100,000 on R&D. There has to be, there's a method. You have to be able to track it. So it's good to be sort of systematic in your approach.
It's definitely good to be systematic. I think,
and it's important to bring an outside service provider.
Because you can do it yourself. Anyone can add that to your taxes, right? But the risk is not in filing the tax. It's in them coming back and auditing it, and then you have to have all that supporting documentation, the studies to say this was actually qualified. So I think it's I learned a lot on that too.
Good. That was good. Thank you.
Cool. Talk to you next week, team. Cool. All right, Tom.
That was good.
Oh, there it is. You're still live streaming.